Welcome to the Special Situation Cast. Today I have a very special guest, Andrew Walker from Rangeley Capital. He's a portfolio manager over there, and he's also the author of, quite a famous blog if you're a stock nerd, which is yet another
I don't know how famous it
blog.
is, but I appreciate that.
Well, I think if you're like a bottom-up stock nerd, I think most people will have found it, or I hope they'll find it now because it's great. And I think you've been writing for ages, right?
Yeah. So I used to write under a pseudonym way back in the day, and then I started yet another value blog 4 years ago. I would say about 4 years ago. So I've been writing that for a pretty long time.
Cool. We'll mention at the end where people can find it, and I'll put it in the show notes. Thank you so much for coming on. And you write a lot about media companies, I think, and I think, is it okay if I say it's like traditional value that you're interested in?
Sometimes I don't know, because like my personal thought is traditional value. Like when most people say that, they think, oh, book value's 10 and I'm buying for 7, or it's trading at a P of 4 times. And I kind of think like, for the most part, all of that's been picked over by computers, right? Like if you're just going to go and say it earned $5 per share, it trades at 20, that's too low, I'm going to buy it. I think most of that's been picked over. So I always want to buy something like, one of the things I've struggled the most with recently is I think speculation has been really rewarded recently, right? And I'm sure every like old gray-haired value investor complains about that to death. But over the past month or two, all these SPACs exploding and everything, like I think speculation's been really rewarded. And for me, like everything I buy with a view, hey, I'm buying it for 50 cents, and I have a really firm view and a lot of downside protection that or fair value to kind of the private market buyer would be much higher than this.
Sure. Yeah. And I've always noticed you do some asset valuations and things like that.
I think asset valuation is kind of the thing that most attracts like the quantitative part of my brain, right? Like MSG is one that I've been really public on, where right now you buy
the Madison Square Garden.
Madison Square Garden, which just did a spinoff. It's now Madison Square Garden Sports, owns the Knicks and Rangers, and it's kind of, hey, you're buying the Knicks. Your MSG market cap is $4 billion, and like anyone would tell you, Forbes valuation says the Knicks alone are worth $4.6 billion, and I think if you put the Knicks for sale tomorrow, I think there would be kind of private equity billionaires tripping over themselves to write a check for $5.5, $6 billion. So, kind of, I look at this and say, oh, it's worth $4 billion. The Knicks are worth $6 billion. You get the Rangers thrown in for free. Like that really attracts me. Though we can talk more about sports teams. I'm actually a little bit more concerned about sports teams post-COVID than I've ever been before.
Okay, because that's interesting. Because I think you've been in that one for years, and you're interested in that entire space, I think, those trophy assets.
So trophy assets, like the great thing about the Knicks and the NBA is there's 30 NBA teams, right? And with the Knicks especially, that is the league's trophy asset. That is kind of the marquee franchise. And if the Knicks were for sale tomorrow, the great thing, it's not like a stock where you and I, we can say, oh, I don't like it at 10 today. I can buy it tomorrow. I can buy it the next day. If the Knicks come for sale and you're a billionaire, you've got one shot in your entire life to buy the Knicks. And, like there's so much political power and all these other things that we don't think about that's associated with being the owner of a team, right? Like every person in the city is going to come to you. You get political power over politicians. There's so much associated with it. There are tax breaks, everything. You get your name out there. Like you and I, there are hundreds of people richer than James Dolan who we can't name, but we can name James Dolan because he's the owner, he's the controlling shareholder of the Knicks. And I can also name him because he's probably the worst owner in the league, right? But there's so many things associated with buying these things. You only get one chance to buy them. So when these things go for sale, they're going to go for a mammoth premium. And that's what really attracted me to the sports team. And also, scale is such a big thing in today's world. And the great thing about the sports is, 20 years ago, they were really only getting domestic, and the international opportunity, especially for the NBA, is enormous, right? The games are played. If you're only playing them in the US, you get some money, but if you can play them everywhere, right? You can show
Yeah.
them everywhere. And as you continue to tap in kind of, especially the Chinese market, that can create a lot of value too.
No, and I think
And that value should flow through to the bottom line.
yeah, and I think the NBA organization has done a good job of promoting the sport on a global scale.
They're
It's not all
decades
sports
ahead
are.
of decades ahead of every other sports team, every other sports league. You know, NFL is only US. Soccer is obviously global, but that's got much different. The NBA has been in China for decades. They've really focused on international. They've got great stuff going on in Africa. It's a great game globally because it's very simple. Pretty much anyone can play it. And I personally think the NBA's got Adam Silver. I think he's by far the best commissioner in sports as well, which, especially in COVID times, I'm actually kind of writing a post on this. Like, you know, sports leagues, the great thing in normal times is they all had this great tailwind, right? Where there was
Yeah.
so much interest in them. And as people got richer, attention was one of the driving things that just got more and more valuable. But in COVID times, like you see this, the MLB is probably going to have a strike this season. And, you know, it's just destroying, tearing apart of the league. And that's a failure of leadership. Whereas Adam Silver is able to get every owner and players and everything to buy into his idea for a restart. So in these
Yeah, it's still a little
crisis
bit up
scenarios,
for debate, right? I'm not sure if it will go through, or are you convinced it will be on?
the NBA.
Yeah.
So I think they've got the buy-in from the players and the owners. I think the
Okay.
only thing that derails it is you can't control the disease, and Florida's seen a spike in COVID.
Sure.
So, you know, if COVID's just running rampant through Florida, and especially if some players get it, they're going to have to pause. But he's at least managed to get the buy-in from the players and the
Yeah.
owners, whereas the MLB's over there waging media wars with their own players when they should be, you know, they should be kicking off July 4th. They should have national attention on them, and it's really going to set them back, I think.
Okay, I'll try to summarize this idea a little bit for people who haven't read about it on your blog for years. And I think it did some simplifying transactions in the years past, right? Because it used to be a more complex
That's right.
holding company. And I think I've heard you mention on, I think the Hedgeye podcast, that Dolan, he gets a lot of flack for being a bad owner. And I think that's partly because the Knicks is a very high profile asset. There are other bad owners, but he doesn't manage the holding company so terribly, or that is
Yeah.
not managed.
So his history of capital allocation at MSG, you know, it's not ideal, but it's actually pretty good. You know, he sold, like, they owned Fuse Network, which was a little cable TV channel, and they sold it for like a couple $100 million, if I remember correctly. And if they had waited 18 months later, it would have been basically a zero, you know. And he bought the Forum Arena out in California for 20 million. And people at the time, you know, it was very run down. This is where the Lakers played in the 80s. And it was very run down, and people said you're wasting money, and they put money into it, spruced it up, and that arena is probably worth. Actually, I think they just sold it, if I remember correctly, but you know, they probably 4 or 5x their money on that. Uh, MSG, they did $1 billion renovation in the early 2010s, and people were saying, "Hey, this is lighting money on fire. You shouldn't be doing this." And I think the returns they got from that were probably in the low to mid teens, which are obviously fantastic returns for any company. So I think his capital allocation has been better than most people would suspect. Though I will tell you, the way he's handled the past year with the Knicks is kind of, he is the worst owner in sports, maybe excluding Dan Snyder. And the way he's handled the Knicks over the past 6 months to a year has absolutely damaged the franchise. Probably not too much, but it has damaged the franchise's long-term value. You know, when
Okay.
the NBA suspended in mid-March, there was only one owner who voted, "Hey, let's keep playing. I don't want to suspend the season." And I'll let you guess who it was. But that type of stuff does damage a franchise.
Sure.
And again, investing in a crisis, I'm worried that Dolan's leadership or lack thereof actually is going to become an issue.
And you know so much about this team. Is there any chance that like that he is a little bit stingy, which is why the team doesn't do well?
No, he actually spends money. I mean, the Knicks consistently
Okay.
have one of the highest payrolls. He's willing to pay up for executives. You know, he went and wrote a big check to Phil Jackson. He's willing to go into the luxury tax. The issue is, you know, he's I think the higher up in anything you go, the more it is, hey, can you control your impulses? Can you control, hey, I want this marshmallow now and wait to go get 3 marshmallows tomorrow? And he has to win every press conference. He has to win now. He's always in win now mode. He's not able to stick to a long-term plan, and he is his own worst enemy.
Sure. Okay. And that is translated in like not signing amazing players that end up in Brooklyn.
I mean, I think that's one. Again, that's one of the things where he's damaged the franchise. In March, he goes on last summer, he goes on the radio and he says, "We're going to have great success. We've had top free agents reach out to us that they want to play for us. Wink, wink, Kevin Durant. Wink, wink." And the organization is so mishandled. He goes and he kicks out Charles Oakley, has national PR nightmare from this thing, and the players leave. And you look at it over the past decade, no marquee free agents want to come here. He will sign awful players to top dollar contracts in win now moves. It's just been mismanaged for over a decade. Half the teams make the playoffs in the NBA, more than half the teams. And I think the Knicks have made the playoffs 3 times in the past 20 years. Like, literally a monkey could do better than what he's been doing. But,
okay.
Yeah.
And so he's, very involved with the whole player contract thing.
Yeah, he's awful. Yeah,
he's not going to get a good awful. GM and.
That's the question. The hope is he can get a good GM, but every good GM, a couple years ago, I think David Griffin, who's a very respected GM, was coming up here, and the Knicks, like while he was on the plane to interview with the Knicks were having more PR nightmares, and Griffin ultimately decided, I'm not going to do this. A lot of people think Masai, the Toronto Raptors GM, will come save the Knicks. I mean, that would be great. I think the best thing for the Knicks to do, the best thing would be Dolan selling the team. The second best thing would Dolan be, I'm not touching it. Masai, you have all the power. Go do what you did in Toronto here. Build it up long term. But I just don't know if he'll be able to resist the impulse to tinker and control.
Sure, I think that's very rare that somebody who is meddling stops meddling. But who knows? I'll move on to more of your ideas because I like this basketball stuff too much. Are you also like quite a gamer? Are you both into? I read your blogs. Are you into video games or more like board games or any game?
I'm into both. Try not to spend too much time playing either. I love games. Escape rooms, I'm an absolute maniac with. Any board games, I love anything competitive. Video games, all that type of stuff. I love it. I'd love to find the right kind of avenue to invest in the public markets with it. Mm-hmm. If you think of the history of the past 5 to 10 years in public markets, if you invest in gaming stocks, it's done really well. And I've come close to investing and passed on a couple.
I knew Blizzard really well. ATVI.
Blizzard.
Just stand by and watch it run.
And that's the thing, every time I looked at them and I just couldn't get there on the valuation, and it's been a mistake. The one I kind of kicked myself the most on is Games Workshop. I'm not sure if you're familiar with this out in.
Well, we talked about it last episode because I had Liz on and she invested in it, and I like these kind of stocks. But you know it, and
I wrote it up 2 or 3 years ago, and probably 200% ago. I love the story. I love the IP. I just couldn't get there on the valuation. But the thing with great IP that people love, it's similar to sports. It scales, right? Every incremental user you get, it falls straight through to the bottom line. And hey, if you've got a really popular board game, you can have like a Witcher situation, right? Where you turn it into a Netflix show and the thing explodes. And I pass on Games Workshop.
Yeah, and it's
that's
like
one of my biggest mistakes.
I think in the early days of gaming, people underestimated like the sequels, how strong the sequels are.
Mm-hmm.
And but I think there's also a little bit of like in hindsight, we analyze like the great successes.
And I don't disagree, but with games, like I think the thing a lot of people miss was with games, you could spend $50 for something that you would invest 100 hours into, right? And with the new streaming world, you could spend $50 for something you'll invest thousands of hours into, right? And these things do have like pretty strong networks effects. Something like Fortnite. You go play Fortnite because all your friends play Fortnite. And then because all your friends play Fortnite, you keep playing it. And these things do get pretty strong network effects. And obviously,
Yeah,
the microtransactions has completely changed the games for a lot of these things.
yeah. I think the esports, which you probably know a lot about, is an attempt to strengthen that. Like,
Yeah, esports will be really interesting. The thing with esports, again, with esports, I haven't found the right way to play it in the public
yeah,
markets, right? Like, you can go by the video game publishers, but if you consider like how much esports moves the needle for them versus their actual video game thing, it's kind of incremental, but it can solidify a game as super popular. League of Legends, I think, is the most popular game in the world. It's been that way for 10 years, and esports is a
yeah,
big reason why.
yeah. And it gives like these old games so much legs. I've always been a StarCraft player, and
Still
yeah,
super popular. Do you play the original or StarCraft 2?
well, right now I don't play any of it, and I tried it again, and it was like super slow compared to what I used to be able to do as a kid. It was funny.
I,
Yeah.
when I a couple years ago, a couple of my friends and I were like, we're gonna bust it off. We're gonna play StarCraft, and we did. We're like, oh my god, we're so bad at this. It's really a skill. It's really a skill, and that skill actually, again, it's an investment of time. And once you get someone hooked on that investment in time, they probably don't want to switch and go make that investment into something else. So it does create a really interesting lock-in.
Yeah, for people who don't know, it's an RTS, which is a real-time strategy, and that means you have to make strategic decisions, but also a little bit of like you need some dexterity to control the mouse and make your guys do what you want them to do.
And if
That's
you've ever
pretty hard.
it's funny people make fun of gamers as not athletes, which I get. They're not athletes in the traditional like rip six pack sense, but their hand-eye coordination and their reflexes and stuff. If you ever see them, like if you see a warm up for one of them getting ready for a match, they're clicking all over a mouse, and you and I could not come close to matching what they do.
Yeah, for sure. And yeah, I don't know, how much that's knowing what you want to do and preparation, or how much it's like inherent talent, but it's crazy. And I think they burn out really quickly. Like if you're mid-20s, you're already slow.
Yep,
I think
yep.
it's
It,
true
it
for
requires the
chess.
super fast twitch reflexes and everything.
Okay. um I don't know how we ended up here. Oh, I was asking you about the gaming. I thought it was also very interesting, and that tied a little bit into investing. That you wrote about like social games, which is like werewolves, and
Yeah,
yeah, I've played professional poker myself, and so I really like games. And but you can bring a lot of it over to the investment world, and I thought you had a great example. And maybe you wanna. It was
so
with the
if
insight.
if I remember correctly, the example was, you know, in April, and I think a lot of investors are struggling right now with markets are back close to all-time highs. And I live in New York City, and like literally the whole city is locked down. And it's tough to justify inside highs with the economy everyone is seeing and insiders. With poker, a lot of it is reading the man, not the cards, right? And for me, a lot of investing has been you read the man. What's everyone's incentives? What are the insiders doing? What are they revealing with their actions? And in April and May, I've never seen insiders in companies sell as much stock as kind of I saw during that thing. So to me, the insiders are saying, "Oh my God, we're terrified. Our companies are desperate for liquidity," and that's not really a situation where I want to buy into. My favorite things to buy are when insiders are I've or when they're super greedy to buy their own shares, right? The company is buying back shares. Every day you see a Form 4 from the CEO, he's buying more shares. Everything they're doing is saying our stock is undervalued. And in this market, for wide swaths of it, it's kind of the opposite. And the stock market just hasn't cared, like stocks are racing higher. And I could see a scenario where, Buffett, I think at his meeting, he was more bearish than probably we've ever seen him. And I think part of it could be if you're getting data, right? You're getting railroad data, and it's saying, hey, the railroad data that you saw in the economic crisis of 2008, this data is 15 orders of magnitude worse than that, right? Well, it would be difficult for anyone to be kind of bullish and look long term with that kind of data staring them in the face. But maybe the market is looking and saying, hey, this is a 1 year blip. We're looking 3 to 4 years from now, things are going to be just fine. That's why we can do this. I don't know. I don't know where I come out on it, to be honest. I'm a little more bullish now than I was 3 weeks ago, but I'm still absolutely terrified. COVID cases are still spiking, and
Yeah,
it's scary. I mean, the whole economy seems to be reliant on fiscal stimulus and unemployment insurance. I'm speaking U.S. specifically, but
yeah.
it's a very scary thing, and I've never seen something kind of so binary and scary before.
Yeah, but you wrote a few articles about that, how you were confused about that whole dynamic, and I thought they were really good because I share the exact same feeling. Obviously, I mean, everybody knows economy is kind of getting killed, and in a unprecedented fashion. But people different opinion. How long will that last? Like how fast will the rebound be here? And the stimulus is big and it's noticeable.
Yep.
And the confidence effect, I think, is real. I think there's something to be said for that. Powell, he went all out, but the fact that the prices are rising, I think it helps people get back out there. If markets were still like 50% down, I think people would have a harder time, like um, moving on from, yeah,
It's especially
from an,
spending, right? Because if stock markets are down 50%, I mean, I don't know how much it bleeds into Wall Street, but I do think there is something people see that and they say, "Oh my God, we're in the greatest financial crisis ever. I need to save everything, guns, ammunition, toilet paper, apparently. That's all I'm putting my money into." Whereas with stock markets, not really down.
no, I
I do
mean,
think you're
yeah.
right. People feel confident. Hey, the stock market's saying things are going to get back on track. I don't
Yeah.
have to kind of hoard.
No, I think people are taking it as a huge signal, which I'm kind of waking up to that effect. I think Trump was kind of ahead of a lot of people, in that it's a very strong signal for just normal everyday people, who maybe don't watch bond markets as much, and actually the stock market's kind of small, but yeah, I think it has a real signal effect. But um, won't won't talk. I'll move on to some of your uh, super interesting ideas, because otherwise we'll run out of time and still be talking about
Yeah,
stupid virus. Um, hey, you mentioned, we were talking before we started, and you mentioned Kontoor Brands. Um,
yeah. So this was actually I've started a premium site, and this was actually the
mhm.
premium idea for June, but it's one I really like. So
So
Contour,
it's
I
your
actually wrote a
latest write up there, or your
yes,
okay?
and I might post it publicly, kind of as I'm thinking about doing case studies once the ideas have played out. Though you have to hold yourself to the good and bad, right? Like I don't just want to post the good case studies. You probably need to post the bad case studies too, which can get a little awkward. But unrelated, Contour wrote them up last year. They were a spinoff from VF Corp, which they own. North Face is the big brand. They're a big brand owner, and they've done fantastic. They're kind of an outsider type company, right? They buy brands, they grow them. They're very shareholder focused. Well, Kontoor owns Wrangler and Lee's, very famous jean brands. And these are kind of cash cow brands, especially how they were managed in VF Corp, where every other brand they owned was growing pretty quickly and nicely. And these were just cash cow brands. They didn't really invest much into them, and they spun them off. They spun them off last year. And when they spun them off, it was the classic, hey, we're going to give you one share of Kontoor for every seven shares of VF Corp you own. Kontoor is much smaller. I thought there was going to be a lot of force selling from people who wanted to invest in an S&P 500 VF Corp name, selling this kind of tiny stock in
Yeah,
Kontoor.
and
So
I mean, these cash core brands, I think these were sold in Walmart in the States,
yeah,
and
Walmart, Sears,
North
all the big
Faces.
department stores. This is the jeans you find in department stores. They're very American basic jeans, right?
Right, and North
But
Face is more of a cool brand, sort of the
exactly,
times.
cool growth brand, higher margins, all that type of stuff. So they
Hmm.
spun it off, and there were a lot of theses, but a big part of the thesis was, hey, this spinoff, there's just going to be a lot of force selling. Buying a storied brand with with 100+ years of history like Wrangler for kind of seven times EBITDA, which is where it traded at the spin, that doesn't make any sense at all. These guys, they're going to start paying a dividend, and they were very clear: we're a dividend company, right? We're going to pay out most of our cash flow in dividend, and the dividend yield at the spin time was going to be like 10%. So I kind of thought, hey, this is going to, as soon as the spin dynamics are done, dividend focused buyers are going to buy this. This is going to trade for a normal thing. And there were some insider signs and stuff that they kind of thought intrinsic value was a lot higher as well. So it actually played out really nicely. Fast forward to March. Corona happens, right? A lot of their buyers, last year, one of the big issues with Kontoor was Sears was a big buyer of theirs, and Sears went bankrupt. You have a big accounts receivable write-off. This year, I mean, Macy's, JCPenney, all these guys, not all of them have gone bankrupt, but a lot of them are in distress. People stop buying blue jeans for a month, right? So they've got a big issue, and they say, we're going to cut our dividend, right? We're going to resume it when we can, but to be safe, we're going to cut our dividend, which I wish more companies would do. I think that's smart capital allocation. Hey, we're in a crisis. We're not going to send shareholder money out the door unless we know we can afford to do it, right? Kind of different for share buybacks, but why give a dividend when you can put it onto your balance sheet, make sure you're going to weather the crisis? Well, the S&P dividend ETF owns 20% of the company. And when they cut their dividend, the S&P dividend ETF has to sell 20% of the company. And they actually did it in one day at the beginning of June. And obviously, people are front running the fact that 20% of the company is going to get sold. So the stock goes.
Why they did it in one day? Is it just mandatory, or?
I'm sure they arrange it. So their rules require you to do it in a day. I actually thought you could interpret the rules to do it over a month, but people knew the sale was coming, right? And you could go and I actually have it in the write-up. I'll probably post it tomorrow since along with this interview. But KTP bottoms at $14 per share in March with the rest of the market. And the rest of the market goes up like 40%. All of KTB's best peers go up 30, 40%. KTB is flat. Why? Because everybody knows 20% of the shares are going to get forced sold out, right? So it was really a tale of forced selling. But there's also, look, Wranglers and Lee's, these are great brands. And the company was going to survive through to the other side. And, I think intrinsic value is higher. There's other stuff to talk about. But this was really a forced selling play. It actually works out pretty well. The sale happened, the forced sale happened at the beginning of June. I think shares were trading at 14 at the time. And now they're kind of $18 to $19 per share. And I could actually see like the forced selling kind of bounces happened at this point. But the company's very clear. We're a dividend company. And once the crisis is over, they're going to resume the dividend. And guess what? A year from now, the S&P 500, the S&P dividend ETF is probably going to have to buy 10% of this company once the dividend's been turned on for a couple quarters. So you're kind of going to have a forced buying opportunity on the other side, I think.
Cool. And doesn't this company have like a lot of debt? I'm just from the top of my head.
Yeah, so they're levered, right? It's a cash cow story. They're levered, but the nice thing, they got their credit amendments, and one of the reasons they cut the dividend was to get credit amendments that said, hey, every company pretty much every retailer is going to have near-term issues where Q1 and Q2 earnings are going to be really, really bad. So they got a credit amendment. They're going to make it through to the other side. There's no doubt debt amplifies risk, but in normal times, this was pretty reasonable leverage. And I think if you can survive 2 quarters of not earnings going to zero, but basically revenues going to zero with your debt, you're probably pretty reasonably leveraged for brands with this much story and brand equity and everything.
And is there like any chance, because something I've been noticing is that either millennials, which I'm the oldest kind of millennial running around, or Gen Z?
Gen Z?
Yeah. Sometimes they revive like these old brands that just suddenly become cool. Is there any chance it's happening, or?
It's tough to say because like Champion, which when I was in high school, Champion was the Walmart literally like gym brand, right? Like you bought $5 per share gym shorts from them.
I think maybe before that time it's been like a name brand and then deteriorated.
But recently,
like Australian, and there's lots of those.
Yeah, but recently they've become like a niche fashion brand selling like $200 sweatsuits and stuff, right? I don't think Wranglers and Lee's make that, but there are growth opportunities, right? This was run as a cash cow, and they weren't getting into new stores. And recently, Lee's has made really good inroads into China. They've started, since they spun off, the management seems very focused on increasing sales. They've started getting into new stores and new doors. I could definitely see a scenario where not that this becomes like the Gen Z cool brand, but could this be a growth company? Absolutely. And one of the great things about the internet is you might search directly for jeans, and Wrangler's got this great brand recognition. They're at the top of Amazon jean searches. When you search for jeans, they're at the top of a lot of different things, and that's appealing, and there's some upside optionality there. Will it play out? I don't know, but definitely
Sure.
valuable.
No, but it's funny how these things can happen with these fashion brands, that they'll be down and out for a decade and then suddenly come back. It's funny. Let me see. Maybe let's see how much time I've got left. Maybe the Taubman case is interesting because that ties a little bit into this story. It's like a mall story, and then it was being acquired by Simon's Properties. And I think you've written about this, and you had a very interesting take on it.
Yeah, so Taubman is one of the largest mall companies in the U.S. Simon, the largest mall company in the U.S., agreed to buy them in February. And literally, 2 weeks later, every mall in America is shut down, and Taubman agreed to play a mammoth premium. Simon agreed to play a mammoth premium for Taubman. And I think Simon, last week or 2 weeks ago, Simon sued to get out of the merger contract. And Taubman obviously said, no, the merger, you are having buyer's remorse. We should get out of it. So it's a really interesting situation.
Yeah, I think it's usually really awkward if like the acquirer's company tries to get out of it or doesn't want it anymore. I've got this notion that if the acquirer doesn't really want it to close anymore, things become really difficult.
Oh, absolutely. They do, but you signed a merger contract, right? And the merger contract, it's written down. It's law, right? It's an agreement, and having buyer's remorse doesn't mean you can get out of the deal. You need a reason to get out of the deal, right? And Simon is suing, saying Taubman didn't operate in ordinary course and all this type of stuff. But this is a very good merger agreement, and Taubman is arguing. I guess the bottom line is, if you're Simon and you signed a deal in February to buy Taubman for $52.50 per share, and here we are 3 months later, and every mall company in America, its stock's down 75, 80%. What's the downside to going to court and seeing if you can get out, right? There's absolutely no downside to suing. Maybe a little reputation damage, maybe, but pretty much the worst case scenario is the judge says, haha, good try, guys. Go buy Taubman for $52.50 per share, right? And the upside is mammoth. The upside is, hey, every mall company in America is in some form of distress right now, right? Maybe on the doorsteps, you go to Taubman and say, hey, guys, we'll give you $45 per share right now. We don't have to go to trial. You guys probably have a pretty good case, but do you really want to risk it? Do you really you guys are going to have financing issues if this deal doesn't go through. We'll give you $45 per share. If you're Taubman, that might sound kind of interesting. And if you're Simon, guess what? You just saved hundreds of millions of dollars, right? So I think from a game theory perspective, it makes all the sense in the world if you're Simon to go to, it's a multi-billion-dollar deal. Multi-billion-dollar deals, like, reputations can be thrown out the window to save $1 billion. Reputations are thrown out the window often to save a lot less. And this is the biggest merger they're ever going to do. Do everything you can to get it cheaper. But there is a merger. I think Taubman's case is extremely strong.
All right. So you still really like Taubman?
So you're actually going into all the stuff I've written up on the premium site. So actually, the reason I got interested in it was in March, Taubman stock was trading at like $50 per share or high 40s with a $52.50 deal price. And there was no doubt that there was some preferred fund that blew up, because every preferred that I followed traded down to like $12 per share, right? And most preferreds have a par value of $25 per share. So they traded for about 50% of par. And for some of the preferreds, like, the business was imploding, so it kind of made sense. But Taubman had a set of preferreds, which I still actually like quite a lot. They've got some preferreds that, if the deal goes through, will get paid off at par. And the prefers were trading for, about a 30% discount to par, while the common was trading at the time at about a 10% discount to the common price. And to me, I looked at this and I said, Well, if the deal breaks, the common is going to be down way more than the preferreds. And if the deal goes through, you've got this weird scenario where the preferreds are going to be up more than the common. So you've got this heads I win, tails I win scenario. So that's what originally got me interested. And now I'm very interested in the preferreds still trade for about $21 per share, and they would get paid off at par if the deal went through. And now I'm very interested in it as well because the common trades, as we talk about, $37 per share, and the
Yeah.
deal's at 52. So I think Taubman's got a great case. There's a
Yeah.
lot of downside if it breaks, but I'm very interested because Simon's suing for what's called a MAC, material adverse effect. There's only been one MAC in that I'm aware of that in history. It was Acorn's buyout a couple years ago. Pandemics are excluded from Taubman's MAC. There's a lot of reasons why I don't think this is a MAC. I think Taubman's case is really, really strong. And I'm, $15 per share upside, obviously huge downside, but
Yeah.
I think it's a very interesting situation.
Cool. And that's interesting. So you were researching this deal, and as you learned more and more about it, you actually went into various parts of the capital structure or
Yep,
ways
that's
to.
exactly right. Yep,
Yeah, that's
yep.
interesting. And I think maybe something that looks a little bit like this is the Tiffany's deal, which was signed before the pandemic.
Yep.
Maybe you don't know anything about it, but if you have some thoughts on that one.
This is one I'm actively following. It's actually got a lot of similarities to the Taubman story,
Yeah,
right?
that's
Where
why I brought it up.
the Tiffany's contract, Tiffany's was signed, I believe, November 2019. Today, the brands are literally shut down. Earnings are way down. There have been rumblings that Louis Vuitton, the buyer, wants to not get out of the deal. They want a price cut. And Tiffany's is over here saying, no, we've got a contract. We want to go through with it. I actually think the Tiffany's contract is worse than the Taubman contract. The Taubman contract specifically says pandemics are not a material adverse effect. The Tiffany's contract does not say that.
No,
However,
because it's from way earlier.
Yep.
Yeah.
The Tiffany's contract is quite good outside of that. And I don't, if Louis went to court and tried to sue Tiffany's and say this is a material adverse condition, one of the things is a material adverse effect. It can't be a temporary. It has to be, I believe the term is durationally significant. I think Tiffany's would win in court saying, hey, the pandemic lasted for 6 months. Our China sales have already rebounded. Everything's rebounding. By next year, this is in the past. It's not durationally significant.
So it depends a lot on, if I hear you correctly, that is there a second wave, or how long does that last? Do we see
I don't even think a second wave. And remember, durationally significant, you have to be able to prove it's durationally significant. So if we went to court, tomorrow, and you started arguing there's a second wave, your business is going to be shut down, I can say that's your opinion. You can't prove that this is durationally significant, right? So
yeah, but I just mean that's maybe an awkward argument to make while you're in a court case on Zoom or.
Absolutely true, but I don't think it can be proven it's durationally significant. And even if there's a second wave, is it going to be 2 years from now? Does this have an impact on the business?
Yeah.
Probably not. And again, I can point to my China sales. I can point to my May sales are already rebounding, all this type of stuff. So, and in this case, Louis Vuitton has a history of deal making, and I think if you look, their biggest regrets have been the deals they've passed on, not the deals that they've done. Tiffany's is a blue chip brand that they want to own. And I think when push comes to shove, they're going to want to get this deal done. So again, very interesting situation. I think the stock's at 121 and the deal's for 135. So you get that right, that's a pretty big return.
I think it's a 10% spread from top of my head. It's big. It's really big. Well, let's maybe to move on a little bit. Media companies, you're really big on those. I think you are loaded up on cable.
Yep.
What do you like in cable? What's your favorite company, or how do you see that play out?
So my largest position is Glibba, which Glibba is GCI Liberty, which its main asset is Charter. Charter is the second largest cable company in America, and I started getting really interested in this in kind of 2016, 2017. When there was this big story of cord cutting is going to destroy cable companies. And what I'm not the first to realize this, but the cable companies were no longer video companies. They had become broadband companies that also provided video, but all the profit was in broadband. And when I look at broadband, I look at something that you pay $60 per month for, roughly in the U.S., and it is mission critical. And I think the pandemic has only highlighted this, right? In March, every cable company reported the highest ads that they've ever seen across all their territory, because people went home and the first thing they said was, "I need fast, reliable internet." And cable is the best infrastructure on earth. It has mammoth advantages. And even today, when you buy a cable company, you're paying kind of like 20 times this year's free cash flow for most of the cable companies. It's actually cheaper if you go to some of the more levered or smaller ones. But when you run this 2 year forward, they're going to continue to take market share. They've got enormous untapped pricing power. They've got mammoth optionality they've got the fiber already laid out, right? And they've got that pricing power. That fiber can be used for wireless. It can be used for all sorts of things going forward. And when I look at these things, I just see something that is a great business with enormous pricing power that trades for a fair price today. And actually, I think it's too cheap once you kind of normalize a lot of the OpEx stuff. But when you look at it 2 years out, these things are going to spit off enormous amounts of free cash flow. And it's like just the best combination of good management, good capital allocation, great business, safe business that is going to make it through every economic cycle.
Yeah, and I think capital allocation is kind of important too. You bring it up a lot, and I think you're big on the whole media, Liberty Media complex, which is famously run by John Malone. I think almost everyone listening to this podcast will be aware of that, but for new people, there's a really great book about him, which is Cable Cowboy. And on Andrew's blog, there's lots of posts about various parts of the Liberty Media complex, which is giant. And I tried to avoid it a little bit because there's just so many moving parts to it, or so much. Yeah, it's so complicated. But you have a really interesting blog where that is brought to the forefront, and there are lots of value investors who are big fans of Malone, right?
The great thing about Malone is the capital allocation is going to be there, right? He's going to buy back shares. Actually, a quibble I've had, which has been growing over the years, is he does seem to be more of a momentum buyer of his stock. So when times are good, the companies are retiring shares like crazy. But a lot of the Liberty companies kind of laid off the share buybacks in March and April, and these are businesses that a Charter, a cable company, they were seeing accelerated results, and not that is a Liberty company, though they have huge influence over at Charter. They laid off the share buybacks in kind of March and April, right? You look at something like QVC, Q-Rate now. It was buying back shares 2 years ago when the shares were at 20 to 25. Today, the shares are kind of, the shares were as low as $5, and not even during COVID, like in December of last year. And the company stopped share buybacks to kind of pay down debt. And maybe that's right, maybe that's wrong, but if you're buying back shares at 20 in 2018 and then you're paying down debt at 9 in 2019, you've probably done something wrong at some point. So I do think he can be a little bit of a momentum buyer. But the thing is, most of his businesses are really good. They're very unique businesses, and they're going to buy back shares. And that combination, it's catnip to most value investors.
Sure.
And there's always events, right? So it's always exciting to follow them.
Okay, so that's part of the attraction. Maybe we can do one last idea. I don't want to keep you too long.
No, great.
Would you like to talk about Twitter a little bit? I think that's a really interesting company, and everybody knows it.
So Twitter, I really attracted to it. It's got all the hallmarks, I think, of a lot of companies that have done really well in the recent past, right? Like, there's a great network effect there. You've got a business that demands tons of eyeballs, tons of attention, and kind of its market cap to its importance in the world. Its market cap is here, it's very small, and its importance to the world, it might be the most important tech company out there, right? Like, you think, how does everyone get their news from Twitter, or their news in general? It's on Twitter. So that's what kind of first interests me, just its market cap to its importance. And then you look at this thing, and they spend $700 million per year on research and development, and I can't really tell you how the product's evolved over the past 8 years. I think the company is it's managed like
longer
Go
notes.
ahead.
You can post longer notes. Like
Yeah, they went from 140 to 280, or you know,
that's
they
700
spent
million.
somebody I mentioned a couple times I like Twitter, and there's an anecdote where Twitter, it used to be when you liked a tweet, it was a star, and they changed it to a heart. And they had an internal debate for almost a year on changing from a star to a heart, right? And at any other company, I'm sure Facebook, they would A/B test it, they'd see that a heart was better, and it would be done with, maybe some fanfare, but it would be done quickly, right? Twitter spent 9 months on that. Their ad product is awful. They haven't evolved the platform. I think they missed on a lot of things. Like, I think Twitter should have been Twitch. Twitch, the gaming streaming platform. I
Sure.
think Twitter should have been a really natural place for kind of live sports and esports online, because you go there, you go to Twitter for live news. You go there, log on, watch something, tweet about it.
Yeah,
I'm not sure, but
I thought what they
go ahead.
were trying to do with live streaming NFL was really dumb move, but I like the Twitch idea a
Yeah,
lot better.
which at least with the NFL, like, they tried something, right? And it makes sense. Hey, live sports combined with our live tweet product, let's try something. But you look at the product, it hasn't evolved. They spend hundreds of millions of dollars on it. Their ad tech stack, my understanding, is awful. Like, the ads I get there are often completely untargeted, make no sense to me. So, the proverbial thing is Twitter is a clown car that fell into a gold mine. And I think they're kind of run like a clown car. So I think it's interesting because you're paying a very small price compared to its importance in the world. I think you could take a lot of angles. Strategically, I still could see how it could be valuable to the right kind of legacy media company or something if it was put up for sale. I could see how a private equity firm would come and look at Twitter and say, hey, we're just going to buy it. The product hasn't evolved in 10 years. We're just going to buy it. We're going to fire everyone and we're going to run this thing for cash. I think that could be interesting. Or you could talk me into, hey, they're going to level up and they're going to figure out, how is your podcast going to get distributed for the most part? Most people are probably going to find it through Twitter, right? Or they're going to share it through Twitter. Most Substacks and premium newsletters are found and shared through Twitter. I think if you can figure out how to capture any of those things, and the question is always, how do you capture it? But I think back to Tinder 5 years ago. Everyone used Tinder, and no one knew how the heck they were going to monetize Tinder, right? For a while, they tried advertisements, and Match's market cap was $500-700 million, and everyone I knew was on Tinder meeting the loves of their life. And if you think about 20% of the population meeting the love of their life on Tinder and it having a $500 million market cap, like, that is outsized impact compared to market cap. Twitter kind of reminds me of the same thing. And Match is a 7x over the past 4 years or something. Will Twitter be a 7x over the next 4 years? No, probably not. But if they can kind of strike the right combination, the stock is going to be a screaming home run. And there are a lot of different angles that they can go through.
Like Elliot is in there right now. They're with an activist campaign, and I think they're not trying to get Dorsey out yet.
I think "yet" is the operative word. I would be very surprised. I think there's some hints in their filings that a new CEO is coming. I think it makes sense. Look, Dorsey's been back in there for 4 years, and some of his complaints are like, he says, "Hey, the ad product's bad, but that's because the prior CEO left us a bad ad product." You've been in there for 4 years. Like, it's on you at this point. The company's run like a clown car. The stuff with Donald Trump, I think it just shows.
Is it now gone?
Been,
because can't find it anymore. Is it now gone? Like
I don't think so. I don't know, but the fact that where they drew the line was where they drew the line. They either needed to draw it a lot sooner and a lot harsher, or they needed to just let it run. But where they drew the line, it was just emblematic of how they didn't think through the consequences of their actions. I do think a new CEO is really necessary there.
Yeah, it was like a baffling move. I thought it was with good intentions or a good heart, but it was just kind of super unpractical.
Yeah, I think someone saw it and said, "Hey, we need to do our civic duty," and they didn't step up and think, "Hey, we haven't been doing it for the past 3 years. Why is now the time that we're going to do it?" Right?
Or only with this person, or
exactly.
Other people. It was baffling move. So yeah, I thought that was super interesting. I don't want to keep you anymore. I want to thank you so much for coming on, and maybe if people want to read your blog or learn more about what you do, where can you find you?
Yeah, so my blog is yetanothervalueblog.com. You can find all the stuff there. There's also a premium service, which all the info is on there. They can find. But yeah, it's writing is a labor of love. Investing is a labor of love. This has been a lot of fun, and happy if anybody wants to reach out or anything.
Cool. And you're also on Twitter, right?
Yep, that's right.
Or
It's
is it-
Andrew Rangeley, range like a driving range, Ley, Andrew Rangeley. So, tweet everything out, mainly financial filings and stuff. So it can be a little dry, but try to keep it
No,
interesting.
that's fun stuff if you're investment nerd. Okay, thank you so much, and bye bye.
Yeah, thanks for having me.
Oh, sorry.